You didn't make this, all right? So we're going to go ahead and get started.
So your company is the mortgage broker?
Nexa Mortgage. All right, so today we're going to talk about the mortgage broker advantage. And I know a lot of you have probably seen many different banks like Bank of America, Wells Fargo, Chase. They're typically what we call retail lenders, right? So I'm going to explain the difference between what a retail lender is and what a retail lender does, and the difference between working with a mortgage broker. All right. So today, if you don't know who I am Lawrence Martin, author of the book, Who Gives a FICO? I am a mortgage broker with Nexa Mortgage. And our vision is to provide a seamless mortgage process to our clients, okay? Okay, so let's talk about partnering with us and what that means, all right? So the number one thing is removing stress and uncertainty from the process. So we've seen a lot, especially with real estate, with the real estate market changing. There's never like a constant in real estate. Things are always changing, but the mortgage process, what I'm going to show you today, typically stays the same, right? So the first step is really just making sure the buyer and you know the realtors working on the file is well informed of what's going on. Okay, so get into the closing table fast. That's one of our priorities, and also getting you guys paid as soon as possible. All right, so communication is key. I hear this in the industry a lot. If deals are going good or deals are going bad, you want to know about it, right? So communication is the key, and that's one thing that we try to emphasize on. It doesn't matter, about the loan process itself on our end. We need to make sure that we're upfront and communicating with you guys, and just having that open door communication. If the deal is going south or is something going wrong, you want to know as soon as possible. And it's a tough pill to swallow if the appraisal comes back, short, or there's something going on with the loan, you want to know about it. So I want to be transparent and upfront and let you guys know communication is the key, and I want to have that open line of communication. If you see something, because in the loan process, a lot of times borrowers do not disclose everything. And we want to make sure that we're asking the right questions and making sure if they mention something to you, or there's something that we need to know about, then go ahead and let us know. Okay, so communication is key in the whole process. All right, so here are a few of our advantages with working with a broker. One of the things that I pride myself in is just having access to hundreds of programs. All right, there are many different lenders that we do work with. I don't work with all of them, obviously, but there are a few that they're just stellar. They're top notch. They're going to get the job done. So, and the main thing is they have a lot more to offer as it relates to your clients. So some can go down to a 580 credit score, 550 credit score, right? It just really depends on a client's profile. Okay, so there are many different ways in which we can get a file done. Unlike the retail side, they have tailor specific to what they're going to approve and what in some of their qualifications and guidelines. So I want to explain the difference between the FHA loan has their guidelines, right? And then there are lenders that have their guidelines on top of those guidelines. We call those overlays. Okay, so in most wholesale lenders, they do have slight overlays, but they're not as much as like a retail lender, such as like a Wells Fargo or Chase. So that's one of the reasons why it's really good to have that leniency working with wholesale lenders, and they're very competitive. So that's one of the reasons why we're always going to have very competitive rates, and we're going to have very, very competitive turn times as well. Wholesale lenders typically like to focus on a few products as it relates to mortgages, and that's one of the reasons why their turn times are a lot better. So they're not worried about your checking, your savings accounts, and they're not worried about your credit card accounts. They're focusing on mortgages, and that's one of the reasons why wholesale lenders in the wholesale side, we typically move to file a lot faster. All right, so here's just basically 8 points on our process, if you don't know. So the first thing we do, we basically take a 1003, and this is very critical because the whole process is hinged on this 1003. And this is where we need to make sure that our clients disclose all the information upfront as possible. If they had student loan debt that's in default, if they've had child support or taxes, IRS liens, anything of that nature that may not show up on the credit report, we need to vet them and just ask them, and hopefully they'll be upfront and honest about it, right? But mainly the 1003 is the most important part of the aspect. Once we import that 1003, we'll send an email confirmation disclosure package, including the 45062T. And once e-sign is complete, we order the appraisal. Okay, so immediately after we get the 1003 uploaded, we order the appraisal. All right, then we submit the documents to the underwriter. 100% e-sign docs. Most of the time, we can get this automated, such as your income, your asset documents as well. All right. So once the file is set up, we typically take 24 hours, 24 to 48 hours. If we have all the docs set up, we'll take 24 to 48 hours. And then underwriting turn times typically is 24 to 48 hours as well. So the process really, if we have everything in front of us, we can send it to underwriting. Most cases, especially now, we're getting same day approvals once we get it to underwriting. All right. So once we get the approval, initial approval, basically we'll go in and review the conditions and then send them back to the client to make sure that we can cover all the conditions. Typically, we're going to look at home insurance, getting the appraisal back, title, we're going to order title. And that's pretty much it as far as what we're going to do on our side. Now, what we do as far as initial CD, a lot of times, realtors are concerned about making sure not at the last minute someone sends out a CD, but we do that at initial. We do that at the initial approval. So we make sure that the CD comes back within 3 days once we send out the approval with conditions, okay? Then the next step is really to clear the close, okay? Loan information and fees confirmed, choose closing dates, confirm vesting settlement address and title contact information, generate an email prep package, a custom conglomeratory CTC video is sent to the borrower. Okay, so we send that CTC video to the borrower and the realtor as well. And then one of the great things about it is point 8, we pretty much have hands-on control of the closing process altogether. So we're not waiting on another department. In most cases, a lot of lenders have, other departments where they have the closing department, right, to prepare the CD or whatever, but that's on our side. So our team basically handles that. So if there's a CD, something in the CD process that needs to be addressed, we're going to address that issue and we're going to handle it. All right. So that's a beautiful thing about it. We control the closing process. All right. So this is a little video that basically we show your client and also send to you as well.
Your loan is clear to close. As we approach the end of this process, we'd like to thank you for choosing us and your real estate agent partner. We've enjoyed working with you. We've enjoyed working with each other, and we hope you've enjoyed working with us. We'll be in contact soon to schedule your closing. We'll sign the papers and pick up your keys. Again, thank you for choosing us. We hope you've enjoyed your experience enough to refer us to your friends and family, and will come to us for any future mortgage or real estate needs.
All right, so that video is sent out on behalf of the realtor and the loan officer as well, so to your client. So once we get a clear close, it's customized to the information that's on the CD.
Does it also put like the even though they already know who their agent is and all that, it doesn't put like the pictures of the agents up there?
It doesn't put the picture of the agent. It's just basically the name of the agent and also the name of the loan officer. So, all right, so let's talk a little bit about loan options to fit your buyer's needs. So we have conventional loans, 3% down, FHA, VA, USDA, jumbo, QM, and non-QM loans. All right, so these are the basic formats of all mortgage companies. Fixed and ARM options as well. DSCR loans, which falls in that non-QM category. Bank statement loans, niche products, and more. So there's a lot of mortgage-related products that we do have, and I'll introduce to some of you guys if you don't know what they are and how they can benefit your clients. Okay.
What's the popular loan product right now? 'Cause it used to be FHA
Uh-huh.
and then it started going conventional.
Mhm.
With today's market, what are you seeing most?
Well, FHA is still a popular one, especially for first-time home buyers. Because it's a lower barrier to entry. FHA rates are typically lower, than conventional loans. So the barrier to entry to qualify is going to be FHA. And even in this market, there's still sellers that accepting FHA. Conventional is going to be a stronger loan, and if they can go conventional, they should. But FHA is still the key product for first-time home buyers.
Are you seeing newer arms though with the way the interest rates are?
Yeah, we are seeing a little bit more homes, but not a lot, because there's a lot of education that goes into
Fear.
homes. Yeah,
There's still a lot of fear on it.
you hit the nail on the head. There's definitely going to be a little bit of fear because of what happened in
What's
2000.
past,
Yeah, past. So, but I think arms are a great product if it makes sense and people understand it.
Yeah.
I don't push people to products that they don't understand. I make sure that they understand it. And I'll give them the education on the arm, but if they're reluctant or anything, I just back off of it
Yeah.
because
So, have you worked with the HANDS program, the assistant?
actually my first house I bought was with the hands, but not on the mortgage broker side. I haven't worked with them. No. Yeah.
Because I have a customer right now that they just did the HANDS program.
Mhm.
They just got through last month.
Okay.
So that's something I need to.
What about the hometown hero?
So we're not doing any like hands or hometown heroes. We do have PPA in-house programs. We have about 5, but one of the reasons why, because the main thing for us is keeping that commitment to close on time, 15 to 21 days. So that's really key and important to us. Just trying to make sure that we keep that reputation, that no matter what, we're gonna close within 30 days, from the time frame that we get them. So these programs typically, when you have third-party underwriters, they don't have the reputation or the same business ingenuity to get these loans done in a timely manner. And then their debt to income ratio. So one lender may have a debt to income ratio, and then this product may have a debt to income ratio. And that may be an issue if, let's just say, they're barely qualified, So there are little things like that most wholesale lenders are going to back off of, and they would rather do their own in-house.
So, but let's say with the HANDS program, from what I'm understanding, these people get a assistance up to, I think, 45 grand.
Mhm. Yeah.
So, I mean, and that's what they're looking at. They're looking at them not have to come out with that money.
Right.
But with your program, they won't have that assistance.
Right, they won't have that assistance. So basically, it's it just is really dependent on the borrower.
Yeah.
What type of borrower it is, and basically who's in the market for like first-time home buyers programs and down payment assistance.
Mhm.
That's really what it boils down to.
Yeah.
So, but yeah, we'll definitely look into it. Hands has been around for
Been
a
around
minute.
a while.
Yeah.
Yeah, but I still don't understand it. I've never actually dealt
Yeah.
with it physically.
Uh-huh.
So this person I've talked to today, he was telling me that they just completed that program, so they have that portion
Okay.
to work with. So,
Okay.
I mean, if it's better for them to go with a FHA but still yet, they're gonna, in their mind and in their head, they're thinking about, but they think it's free money, but it's
Right.
never free money.
Oh, no, it's definitely not
Exactly.
free. It actually is more expensive because it compounds on the back end. And they want to make sure that, they basically have, let's say, enough time to recoup their funds anyway. So that's why a lot of times you can't sell or refinance within 5 years.
5 years.
Yeah.
5 to
Yeah,
7,
unless,
yeah.
most of the programs are like that.
Yeah.
Yeah, so the QM quadrant, basically there are 4 loans that we deal with: FHA, VA, conventional, and USDA. So I'll just explain a little bit about the differences in the qualification types. So down payment for FHA is going to be 3.5%. VA loan is going to be 0 down. Conventional 3 to 5% for first-time home buyers, and USDA is 100% financing, 0 down. All right, credit score requirements. FHA typically, to get that 3.5% down, you're going to need that 580 credit score, and that's FICO. All
Are
right.
you really doing anything at 580 now? Or
Yeah. I mean, there are wholesale lenders that will approve a 580. You know.
'cause most people now I know they're talking about 620.
620.
Right. And that may be more on the resale channel, the retail side, you know. So, and a lot of times, you know, those are overlays. Like FHA purely is a 580, 3.5% down. Now, if there are lenders that require 620, then that is what we call an overlay. That's an overlaying guideline.
So if I come to you with a customer that's a 590
Mhm.
and they have their 3.5% down,
Right.
you can get them into a.
Oh, yeah. Absolutely. Now,
Yeah, as long as it's guys.
right, DTI, you know, right, that's going to be a factor, and also what we call other compensating factors like verification of rent for 12 months.
Mhm.
If they would have to have something like that. So,
History.
yep, that type of thing. So, I mean, really, it makes the underwriting process tighter. If they do have a 580, it's not going to be the same. They're not going to get the same rates. The debt to income is going to be lower, right? So those are factors at 580. I do recommend that they do come to 620 at least, so that way, you know, they won't have all those
Stress,
hiccups. So,
yeah.
yeah, exactly.
Probably reserves and stuff like that.
Reserves, right, exactly. Anywhere from 3 to 6 months reserve. Most cases, you're not going to see reserves on the FHA in most cases, but it's still good to have at least 3 to 6%, 3 to 6 months. Yeah. All right. So across the board, closing costs is going to be about the same, about 3 to 5%. You know, depending on the discount points and the fees on the loan estimate. Mortgage insurance is required on FHA. It's not required on VA. It's required on conventional up to 80% LTV, and then USDA it is required. Okay, but it's not as much on USDA. All right, seller credits up to 6% on FHA. VA is up to 4%. Conventional up to 3%. And USDA is up to 6%. So anytime you're negotiating seller credits or seller concessions, you want to keep that in mind. Like there are some realtors back in the past, they would negotiate 30, 40,000 because the roof needs to be replaced. And it's like, well, we got a cap, so we can't go up, especially on conventional. It's only 3%. So just keep that in mind as you negotiate.
So now, if let's say because I have my home I'm trying to sell right now,
Okay.
and I have a solar on it.
Okay.
Okay. So, and I still owe on the solar. So if I want to give the seller a credit
Okay.
for the solar, I can't go beyond those.
Right, exactly. So if it depends on what your buyer is, what type of loan program, right?
Right.
So if they're going to FHA, you can't go up to 6%, you know, conventional unfortunately.
So let's say I can't give them 20 grand towards
No.
the solar, I have
This
to give them.
6% of the loan or the selling price.
It's
Yeah.
going to be, it's going to be up to 6% of the sales
The
price.
sales
So
price, yeah.
the seller can say it's 6% of the sales price.
So yeah, I could do so.
Do
Okay.
you guys offer, so if somebody does have, because there are a lot of people that have solar on their homes now,
Okay.
that are not paid off.
Right.
Do you offer some kind of option for the loan and the solar to be
Rolled in
combined? Like a.
because of
like
the
if
value, if the
property
value.
appraises for what both are worth.
Yeah, let's say I'm selling my house for 300,
Okay.
and the actual value of my house is 350.
Okay.
Okay, and with the solar,
Right.
I'm selling it for 350
Yeah. You can absolutely do that.
because of the solar, but
Yeah.
my actual sales price was 300.
300. Right.
Right, because I owe 50 on the solar.
Right.
To get it paid off for them, we push it up to 350.
Right. You can do that. You can
Okay.
do that because really the lender's only concern is,
The value.
does the sales price equal to the appraised value? That's the only thing
that's
they're
it.
concerned about. All right. So yeah, so the debt to income on FHA is up to 56%. There are some 56.99, but you know, that's very rare. VA 41%. Now we can go up, and it really depends on the lender and the buyer profile. VA, to keep in mind, they're not number one credit score sensitive. The VA loan itself, they don't require a credit score. It's just lenders require credit score. The VA really looks at the credit profile more than anything. So when we send it to the automated underwriting system, it's going to vet that credit profile. If there's, they can have a 700 credit score, but if they've been late within the last 12 months, the VA will deny it until they, get that 12 months out the way. So that's just a case in point. And also, if they have low credit scores, the debt to income ratio is going to go lower as well. The VA, I've seen the VA go up to like 59% on the back end ratio, right? But it just really depends on the buyer's profile, how much cash they have, and, much reserves, and those types of things. So conventional 45%, they could go up to 50% as well. Now, conventional can be very tricky on the credit reports. Really, you don't want a buyer to try to go in under 660 or 680 because that's a low credit score for conventional. Yeah, you really want them to have at least a 700, so that way that could increase their debt to income ratio and their buying power. So if you look at the debt to income ratio, let's say if there's one borrower, that's another factor. So if conventional, if you have two borrowers, you can go a little higher because you have two people on the loan, even if that person doesn't have any income. So just keep that in mind. You say husband and wife, the wife, maybe she doesn't have the income, or vice versa. You can still add that person to the loan, and they could get a higher debt to income ratio and get approved. So USDA is probably one of the toughest loans when it comes to debt to income ratio, right? So just because someone qualifies for FHA with a 56%, you don't want to try to push them into a USDA because USDA is very strict on the front end and the back end debt to income ratio. So they're looking at 29% on the front end, and they're very strict. They don't give us any leeway on that because it's 100% finance, and how they look at these loans, if you're not putting any skin in the game, it's going to lower your approval amount. Okay, so that's basically what we call qualified mortgages or QM loans. And the QM loans, keep in mind, have the lowest barrier to entry as it relates to down payments. So let's talk about the non-QM loans. The non-QM channels are becoming more popular. More people are knowing about them. Like we have the DSCR loans, loans for investors that do not require any proof of income. All right, bank statement loans for business owners that are not eligible due to maybe their tax returns. They don't want to show any taxes. Bridge loans used for fix and flips. And we do have, specifically rehab loans as well. And then also now what's becoming more popular in the wholesale channel is home equity lines of credit. So typically that's a bank product. That's more of a credit union, local bank basically pushes this product, but now they're becoming more popular on the wholesale channel due to the fact that wholesale lenders are looking at people who have equity in their homes but don't want to refinance their first because they got a 2 or 3%. So they're bringing this HELOC to market now, and more people, it's becoming more popular.
There's specific score for.
So HELOC's at 640.
640.
It's really just it's going to go under the conventional guidelines. All right. So the DSCR. Let's talk a little bit about that. And I wanted to share these two, DSCR and bank statements. So DSCR, 640 credit score up to 80% loan to value, 20% down. So if someone doesn't want to show their taxes or any of their income, they can use the DSCR loan to qualify. They just got to make sure they have a 640 credit score and 20% down at least.
Is there a max investment? Oh, yeah.
Up to 2 million, yeah. Now we do have lenders that'll go higher, but 2 million really is the basis of it. All right. The main thing with the DSCR is the rent schedule has to cover the mortgage. That's the whole point of it. So basically, if the home is getting $2,000 for rent, we want to make sure that it covers the mortgage. Make sure the mortgage is not more than $2,000. That's the whole point. And then that's how we calculate the income for the property. All right. So you're going to get two different appraisals required if the home is over 1.5 million. So typically in the type of appraisal that we get the appraiser to do a market rent analysis, a CMA on what the what the market is for rent. And they have to have 12 months reserve. There are some lenders that will require less reserves, but mainly you want to have the basis of 12 months to make sure that you qualify. Minimum of 2 months consecutive bank statements are required to make sure that they do have proof of funds for at least 20%. All right, any questions on that? Yes,
Let me
sir.
ask you this question. What if you have a new company you start up and you want to do, investment, let's say buy multi-family properties,
Right,
and you see something you like, but
yes,
you don't have at this point 100,000 in the bank or what, but you do have your 20%.
yes.
You say bank statement, you need to have at least 12 months.
Well, okay, 12 months reserves required. So you don't need to show 12 months, of bank statements, right? You just need to show, let's say if the property is ready for 2,000, we just need to show 12 months, which would be 24,000 in the bank. Yeah. So you 2 months,
2
right?
months bank statement.
Mhm.
12 months
Showing
reserve.
12 months reserve, right?
Okay.
So you'll be fine on that. They're very lenient on these types of loans. The main thing is this loan is really based on the appraisal.
Income, yeah,
Yeah,
and the income of the property.
right, income of the property.
Yeah.
So as long as the appraiser, approves the amount that we're good, we want to get, then we should be good to go. All right, bank statement loans. Bank statement loans are becoming a little bit more popular as well. Okay, I gotta actually update this, but 640 credit score, 10% down for bank statement loans. And also, you're looking at anywhere from 3 to 6 months of cash reserves, all right? So we're not looking at any of your tax returns or income documents. What we're looking at is 12 to 24 months of bank statements, all right? So that's basically it on the bank statement. Now, see, most like entrepreneurs and business owners, they'll go with the bank statement loan because it does make sense financially, and if they're buying a home, to put 10%, they'll have 10% of equity in that house, as opposed to just paying Uncle Sam,
Yeah.
They'll have to pay Uncle Sam. Yeah, exactly. So it does make sense, even though they don't like the idea of putting 10% down. The interest rates are a little higher as well, but there's no PMI on the loan. Yeah, so it does somewhat balance out, long term when you look at like what they would have to go through to actually get approved, but it really depends on the buyer. If they can get it amended, if they can get their taxes amended and go conventional, then that's fine as well. 640 is ideal, but you want to have at least 700 credit score. So. All right. So lastly, I want to really talk about like appraisal waivers, like exclusive appraisal waiver options. So this is really going to be contingent on the property value, right? It's going to be contingent on, how much equity is in the home. And I will tell you, it's rare to get an appraisal waiver. It really depends on, we'll run it through the automated system and they'll tell us, okay, you got an appraisal waiver. So Fannie Mae, Freddie Mac. Freddie Mac is generally your best route if you're going conventional to get an appraisal waiver. So, all right. So exclusive mortgage insurance options, a mortgage insurance starting at 80%. So some of the lowest in the industry, and that's a fact because we compare a lot of our loans as it relates to like the FHA and conventional. We have some of the lowest mortgage insurance in the industry. The jumbo loan options up to 3 million LTV, and we just started this 3.5% down for jumbo options. No MI required. So that's huge for, now you do have to have 12 months or 24 months of reserve, but that's better than putting down 10-20%. Yeah, exactly, on a jumbo loan. So up to 3 million, you're putting 3.5% down. That's a great product. All right, customized loan experience. We do custom locks, 8 to 180 days. And obviously, due to the fact that there's a lot of new construction and, loans move a little slower. That's important. Even though sometimes we do have to go back and relock the rate, but at least if a home is being finished within that 6 months, we still locked in. And you guys know what's been going on from January till now. So many home buyers got pushed out of the market, had a home built right before their eyes, and then all of a sudden, boom, due to the market shift in rates, they
Some
lost
people
that
are going
property.
up to a year now and locked. I think Wells Fargo is doing that, but then Wells Fargo is not as flexible with
Right.
the loans like you
Right.
would be. You know what I'm
Right,
saying?
exactly. So Wells Fargo, but, there's a lot of competition in that area, obviously, but at the end of the day, we're just really trying to close a loan.
That's it.
So we can definitely lock in a rate while buyers shop for the perfect home before they even find a home. We can lock it in. So we can, let's say if we get a pre-approval, we can lock in that rate, especially if rates are trending up. All right. Okay. And then we do have a free instant home value estimator reports as well. So if you guys say, hey, I want to check the value of my home just to get a second opinion, a third opinion, we do have those tools available. Okay. All right. So one of the things that we do pride ourselves in the process is speed and transparency. Okay, with our easy to use online mortgage portals, buyers can submit their loan application from anywhere in 24 hours. We can authorize the credit pulls, order assets. And then as you as an agent, you can look at the loan details, conditions, and the loan status history of that loan as well. So you'll be given an opportunity to, look at the process through your own portal. All right, initial approvals, they can be as little as 15 minutes. If I can get all the documents, I can get an initial approval in 15 minutes. And that's a clean file. So I don't want you guys to think if you send someone, you're going to get only 15 minutes, but it just, that's, no, let me say this, let me preface you with this. So you probably want to make sure that we do a good job and do it right. Because you don't want a 15-minute approval and a denial at the end after 30 days or 60 days of shopping for a home. So yeah, so I mean, I put that in there, but at the end of the day, man, we got to make sure that these buyers are qualified through and through, So loan tracking in real time. We take loans from clear to close and closing docs in minutes. And most importantly, we get you guys paid with instant funding. All right, so any other questions? This will conclude this presentation.
You did a great job, brother.
Okay.
Yeah, you answered the questions I had.
Okay, I mean, we recorded it on the Zoom, so
Yeah.
you can go back and share it with the team.
Absolutely.
But the main thing is really, I wanted to make sure that you guys understand what goes on kind of behind the scenes in, the broker world, and then getting the idea of like the loan types that you're going to typically see, like the 4 QM loans, and then also some of the loans that's coming online, like the DSCR loan, bank statement loan, and also HELOC. So you can kind of pitch that to your client. Just have those conversations with them, depending on what they're trying to do. So the main thing is you want to get with your clients and just ask them what their goals are. Just kind of getting, you never know where someone is. You could probably sell a home a year ago, and then that same person is possibly either they want to move up or move down or move to another state or whatever. So you just never know. So it's just important for us to just keep in contact with past clients as well. So
Thank you very much.
all right, my pleasure. So let's go ahead and hammer out those calls.
Yeah.